Hey guys, Toby Mathis here with Infinity Investing, and today we're going to talk about investing in 2022 and what to expect. All right, so we have three big goons staring at us in 2022. These big, huge goons have names, and number one is inflation, right? Not since 1982 have we seen inflation like this. Like this inflation is nuts, and it's pretty easy, pretty predictable. Anybody who did not see this coming either wasn't listening to us. I kept saying inflation's a lot higher than they're saying because they were giving away money and they were printing out money. So you have lots and lots of money. We were talking about the savings rates all last year about how high they are. They have not been this high since 60s and 70s. You just have a ton of cash chasing fewer goods because we came out of a pandemic and we're not making as much stuff. We have all sorts of supply chain issues and we have microchips. You have all this stuff that is a perfect storm for high inflation. And we have not seen it since 1982 when it was 15%. And I would say we're going to give that a run for its money if we're being honest. Because look at the housing's gone up almost that high and they haven't baked that completely into the cake. It's always a delay where, everything's more expensive. Cars are like 30% higher. Oil has gone nuts. Food has gone up. Everything's going up. And they're going to say, oh, it's 6 or 7% or 8%. Come on. We're probably like pushing high into the double digits. So inflation is definitely there. And what it does is pushes us as investors into companies that can bake that into the cake really easily, right? So, for example, if I have inflation and I am making ketchup, I'm stealing this from Warren Buffett, by the way, because he actually said this a couple years ago. But if I'm making ketchup, it's really easy for me just to raise the price of ketchup. It's not really impacting me all that much, right? It's not going to impact my operations. Tomatoes may cost a little bit more, but I can just raise the price of ketchup pretty easy to all the distributors and to the grocery stores, et cetera. And then it's also advantageous if you have companies that can scale easily. So it's very easy for most, especially good tech companies that are profitable. It's easy for them to increase prices. I mean, shoot, like it's very, very simple. For most mass manufacturers, very easy. It's really hard for some other folks, like if you're manufacturing materials and goods, and it was like what we saw with the housing, where if all when the lumber prices went up during the pandemic, it really, really affects the market. It makes it very, very tough for them to build. They could not keep up with demand as a result, so they weren't scalable. So you're looking for ability to increase price and scalability when you're talking inflation. So companies that I'd be looking at, and I'm not telling you what to buy, I'm just a tax lawyer, but I'm like, look at really good companies that have raised prices in the past. Like the one that comes to mind right away is, Apple. I still have a couple generation ago phone because they raised their prices so quick, but they're just selling them like hotcakes, right? So Apple's a really good one. What's another one? It never stops. Pepsi, Coca-Cola, financial companies, banks, easy. Hey, all I have to do is adjust a number. American Express is an easy one. I mentioned ketchup, so you got to throw Kraft in there. But these are good companies that pay you to own them. So they do have dividends, but also easy to scale. Like it really comes down to it. Easy to raise their price, easy to scale. So that's the big way to fight the inflation. Number two, big goon is interest rates. Interest rates are going to get risen because interest rates are how we fight our friend inflation. And we've been playing the low, low, low interest rate. Let's give away a whole bunch of cash. Let's keep printing it, make it super, super cheap. And what's happened is inflation's run away. So Warren Buffett once said that interest rates kind of to the markets as gravity is to matter, right? So let's imagine that gravity was cut in half for a while. You're going to have people who would normally not be able to, get up and the business would not run because there'd be a little bit of too much weight on them. And all of a sudden you took away all the restraints. and said, go ahead and run your business and get everybody excited about it, even though your business sucks, because we're just going to keep dumping really cheap money on you. And because people can't go get a decent interest rate in the bond market, they're going to go into the stock market and they're going to chase after all of these companies that are actually crappy companies. I call them, like, I'm just going to use them. I hate to say it. It's kind of your growth stocks. It's these companies that it's what it's going to be worth in the future companies, right? There's the old adage of potential. It means you're not worth much now. And what happened is people would be buying the potential. Oh, this is the next big thing, which is never a good idea, which is one of the reasons why Infinity Investing, like, we focus on companies that have had historic increases in their dividends for 10 years or more, because we want to make sure we don't buy into one of these companies that has managed to prosper despite the fact that they don't have very good business models, right? Well, this is the great equalizer. You're going to see interest rates going up, and they're saying, when I say they, the market is baked into the cake, 3 to 5 increases. We'll see if it goes to, 1%, 75 basis points. Does it go up to 1.5? Like, what? Nobody knows. Nobody has that crystal ball, but they're kind of factoring in 3 rate hikes, probably close to 1%, right around 1%. If they have to go higher because this guy doesn't tame, and I think it's not going to be tamed, right? So let's just get that on the table. I think inflation's way bigger than we realize. Interest rates are going to have to go up. And the Fed rarely takes the chance to not overreact. So I'm kind of thinking that they're going to do it again, but I've been wrong before. Maybe I'll be wrong again. But this is the easiest way to think of this. I'm going to use gravity. And if gravity comes back and all of a sudden gravity starts pushing down, the companies that are solid don't care about it. Like, hey, I could, it's kind of like, if you've ever done mountain climbing, you have to carry a 70-pound sack on your back, right? If you're really going for, like for a 14,000-foot peak or something like that. So if you have trouble climbing up the hill without the pack, you put the pack on, and all of a sudden it is ridiculous. You're not going to make it, right? And there's a lot of companies that have been allowed to walk up, and somebody else is carrying their pack for them. And then they're halfway up the hill, and somebody says, "Here's your pack." If you're not able to handle that pack, you're going to find out really quick, and you're going to tumble back down the mountain. You're going to get blown out. What do people do when people start crashing down the mountains? Like, all of a sudden, you're climbing up, you're the investor, and you start seeing companies fly by you. You know where they go? I'll tell you where they go. They go to safe old bonds. They say, get out of the market. Interest rates are going up, bonds are going to go up. You know who else who makes money during when we start raising interest rates? Banks, because banks make their money lending money, and the higher the interest rate, the more they can make it. Now, a lot of it is how much they can get it, but they've been competing with these huge investment companies and kind of the Fed dumping in this free cash into the system. So we've had huge inflation, which is a tax. It's really hosing the poor the worst. Like, that little guy, it was 7.5% last CPI. 7.5%. That means if you had cash, it's like an ice cube. It's losing 7.5% of its value every year. So if you have cash and it's sitting there in the corner, imagine you had $1,000. It's not $1,000 anymore. It's what, 925 or something like that. Whatever it is. I can't do math, right? What is that? You lost 7-8%, whatever it is. It's not a good situation, right? So 925. There we go. So we want to make sure that we're not just that cash can't sit there. It's losing too much of its value with that hidden tax. This is a tax, by the way. That's the easiest way to look at it. People that can least afford that tax are the ones that are barely squeaking by. So when they start to increase it, like most of the affluent, they're like, inflation's smation, right? But it's really hosting the people that are on living wages, right? And then you have to see whether or not wages are keeping up with it. I don't think wages are keeping up with that tax. So I think that people are really starting to hurt. And you don't have much housing because you have this crazy inflationary market. You can't buy a house. Rentals go up. The last time I checked, it was 14.1%. Prices increased year over year in the real estate market 19%, close to 20%. So you just have this nutty stuff going on. So when this really starts to sink in and you have this inflation or this interest rate come in to compete with inflation, you're going to see a lot of unintended consequences. And you're going to see a lot of these companies that are the growth stocks get blown out. The other place I'd be looking, so I said bonds, and I'd be looking at some banks. That's where I'd be going if you're concerned. Now, if you're a long-term investor, and a long-term investor, I'll just give you my secret for success. Here's the code: is you open up a brokerage account, you fill it full of companies that you really, really like. And when I say that you really, really like, they're great companies that you admire the management. We're going to go full on buffeting, right? Warren Buffett. The reason he's so successful is because he buys things with a long term horizon. And one of his best quotes for me is, if you want to own it for 10 years, don't think about buying it for 10 seconds, right? So if you're not going to buy something for the long term, and by the way, it's called infinity investing for a reason, right? If you're not thinking about the long term, don't buy it. Make sure you're buying really good companies that you like. Like, so what do I do today? Like, hey, if you're one of those people that when you're going to work, you like to stop off and get a Starbucks, right? There's a great company. If you do that all the time, hey, I love going to Starbucks. Buy Starbucks. Hey, during lunch, I might go to Subway. Maybe I get a Coke, right? You start picking up the companies that you really like. Now, I personally would look at the companies that are paying a dividend, but that's me. I'm going to tell you that I love dividends because historically, that dividend is about 40% of the growth of companies. So, like, I really want those dividends, but I'm not going to tell you not to get something that you love as a company. If you really love a company, like, hey, I love Google. Hey, I love Amazon. Hey, I love some of these. Okay, they're great companies. They're solid. Maybe you're buying those. And then here's the trick. Once you fill up, let's just assume that you did a one-time fill up, but realistically, you should always be dumping more money in there. But the code, like the rule would be to lose your password and lose your password for like 10 years, 20 years, right? Don't go back and revisit that constantly. Action in the market makes brokers money. It makes the people, the talking heads on TV money. All this hysterics I'm going to time the market. There's areas where you can do that on certain things, like selling options. Like, we're the casino, we're selling options. And when people get crazy, just imagine this. Like, they give you drinks when you go to a casino. They give you free drinks in Las Vegas. So I'm standing here in Las Vegas. We go down to the Wynn, we go to Bellagio, whatever you go. You sit down, you start playing games. Invariably, they're going to come up there and start pouring drinks down you. Why? Because they want you good and loopy, good and excited, emotional, so that they can get you to keep gambling. The more you gamble, statistically, the more likely it is that the casino is going to take all your money. And these billion-dollar casinos were not built losing, right? So the stock market is no different. You have all these people that get all cray-cray when they're listening to the news, and you have all these talking heads and these folks that are always trying to get you to do things in the market, and you're going to become a day trader and all this stuff. Not saying that you're always going to lose your money, but it's a very small minority that's actually able to make a living doing that. The vast majority, which studies, depending on which study you look at, the longest one I've seen was a Taiwanese study for 15 years, where the success rate was about 1 to 2%. Some of the studies in the United States suggest that it's as high as 5%. So I'll use that. You have about a 5% chance of success, 95% chance of losing your money, which is about consistent with what the casinos have. They know that if they get you to play, like, you ever see we have the loosest slots in Vegas. We have a 98% payout or 99% payout. That means you're going to lose 1 cent of every dollar you bet, and they want you to bet $1 million, so they're going to take it. Right? They're going to get a huge amount of your money. Depending on how much money you started to play with, you're going to get to zero eventually. Right? And they know it's just stats. Well, we're the casino. We know it's just stats. We are going to play the market where we are going to make money. Now, if you want to make money actively in the market, I would strongly encourage you to go into the infinity rooms. Make sure you're starting off in the basic. If you're beyond basic, make sure that you're going into the 360 and going to the advanced rooms. because they'll show you how to be the casino where you can sell the option, buy it back when it pulls back. Like if you're good at Bollinger Bands and things like that. Hey, I'm selling it, I'm buying it back. I'm selling it, I'm buying it back. I'm selling it, I'm buying it back. You're buying it back lower, right? Yeah, I'm selling it as it peaks. I'm buying it back. You can make money that way without risking yourself, right? Again, not to badger Warren Buffett, but he has really good quotes. When the tide pulls out, you get to see who is swimming naked. We don't want to do naked puts, right? We don't want to be running around in the market naked. When the tide pulls out, this is the tide. It's going to pull out. It's going to pull back. It's going to, guys, period. You're going to have a period of time when it starts to pull back. It will recover. Like even if we look at 2008, where we had a depression, like we got smacked 38%. It took about 5 years for it to come back. If you're buying for the long haul, you can wait for that. If you're not looking at your account to like lose your password for real. Oh, hex rig, going crazy. You have good companies that aren't going out of business or anything like that. They're good, solid companies. They just keep making money. Their value is going to go up over that time. Period. History is a judge. It always shows us.
Any attempts to pick the times to buy or sell, I think, are a mistake for 99% of the population. And I think that even attempts to pick individual securities is.
One thing that history has shown us is that people always forget history, right? That's another Buffett. I can't help it. I love some of his quotes. All right. So let's go in and let's talk about the third one. The third goon is these crazy runaway valuations. Hopefully you can see that. Make that into an A. Looks like kind of an A. So we have crazy valuations. We have companies that are just at this huge multiple. And the reason being is because when you're giving away money, nobody's going into bonds. And if nobody's going into bonds, then they're going into the market and everybody's trying to buy companies and they're buying like, hey, it's like going into a sale or the sale items almost run out and people are just grabbing stuff, right? At that point, it's like we don't even care what color it is. This is on sale. I'm going to go in there and get it. Or, hey, I'm so starving. Think of this. Like I always think of Disney World and Disneyland, right? The happiest place on earth, unless you're the parent paying for the $12 turkey leg, right? Or whatever they call it. So you're going in there and now, hey, they got you captive. Or you go into the movie place and you got, you're going to buy a popcorn and a Coke and it's going to cost you $20, right? They got you. What do you think happens in the market when there's no bond market? You're going to pay $20 for the popcorn and the Coke, right? But it's not worth it, really. That's a crazy valuation because of necessity. And once they give you another option, so just imagine this: you go into the movie theater and you could buy the popcorn and the Coke for $20, or they open up a little concession area that's independent, that's half as much. I think I'll go over there and get it for half as much. So then these guys have to adjust their prices downward. Well, the stock market doesn't quite operate the exact same way. What they do is you start going over here. Here, there's bonds. There's an alternative. Maybe it's not popcorn. Maybe it's some candy or something else. Maybe it's something that's maybe more nutritious. It's hot dogs and things like that. It's not even great. Salads, vegetables, right? Maybe that's over here. And you have an alternative. And that's all it is. And all of a sudden, the crazy valuations on the popcorn comes down. Somebody who's actually hungry might go over here instead. And that's what the bond market's going to do. People are going to start going over there because people are going to start paying more for the bonds because interest rates are going to go up. And that's what's going to happen. Guaranteed. Now, if you're buying over a long horizon, this is much, much easier. Much, much easier. And you've heard the adage, be greedy when others are fearful, fearful when others are greedy. Well, people were greedy and we were being fearful. Hey, buy value companies, buy really good companies. We've been saying it for years. It didn't change. Well, but all these other companies ran up. Don't worry. We're shooting for really good companies that pay us 3-4% dividends. That dividend rate's going to increase over a year. We want them to keep hiking it up so that we don't even care what we paid for. Tell people It's the story a million times during the infinity investing workshops. Anybody will listen to me. It's like some of the best investors I ever heard. Probably the top investor on the West Coast at the time would tell his clients, don't go opening up your envelope when I send the statement. Just look at how much is getting deposited into your account. In other words, don't look at the value of your portfolio. Look at what's being created from that portfolio. Look what it's generating. If you have a rental house, who cares what you paid for it? Who cares what it's worth? Like, it doesn't have a ticker signal over it. Hey, I bought a rental house and today it was worth 100,000. Tomorrow it's worth 105. Hey, it went down to 95. It went down to 80. Oh my God. Now it's down to 60. Oh my gosh. What does it matter? The rent's $1,000 a month, right? So quit looking at the value. In the stock market, we like to give you the value because that's how they make their money. Again, they want to freak you out. You don't have that over your house. I mean, Zillow's about as close as it gets, and that gets people to sell their houses quicker too. Oh my God, look what my house is worth. Let's sell it. Well, you still have to buy a replacement. Oh, forgot that part, right? Gets you all excited. Then you realize, wait, if the market's up, then what are we going to do? Be homeless for a little while and wait for it to come back down and then buy something? No. Stock market gets us to do things emotionally. So you don't want to look at that. You want to look at what it's creating. So you're buying good companies and they've been not necessarily on sale, but they're going to be. When this market corrects, you're going to see really good companies go on sale. Now, not to disparage any brands, but it's like if you went into Ross Dress for Less, right? And they said, hey, we're going to have a sale. You might go, what's another good brand? Like Nordstrom's. I'm from Seattle. I remember the flagship store, right? My mom would always be like this. Oh, Nordstrom's twice annual sale, right? That's when she'd go. They'd always have stuff, really good quality merchandise on sale. That's what's going to happen. We're going to have some things go on sale because everybody's going crazy. We're not going to go in there and buy 99 cent only. It's down 20%, right? We are going to be looking for good companies. Price is what you pay, value is what you get. That's Bell. What you're looking for is things that are really good values and you're willing to pay a decent price for them. Now, a lot of you are going to be scared, right? Because there's a lot of fear out there, which is when you feel scared, you should be going, it's opposite day. I should be doing exactly what everybody's saying don't do, right? You want to be a contrarian in this market. You want to go out there and look for value companies. You want to look for really good deals. And I'll give you an example. So in December of 1941, right, we had Pearl Harbor. Really horrible time. 1942, America's going to war. Not a great time, right? What if you put $10,000 in the Dow Jones? Just put it in the market. Just bought the index. You bought the whole Dow. What would that be worth now? That was in the middle of a war. And there might be wars breaking out as I'm standing here today. You have Ukraine, you have Russia, you have all this stuff going on around the world. What if bad things start to happen? Well, let's go back to that time. That was a world war. What would have happened if you'd put $10,000 in the market? You may have had a really bad year. You may have been freaked out. Your portfolio may have gone and you're freaking out. If you had put $10,000 into the market in 1942, if that's what you had done, 1942, you know what that'd be worth now? I can't even reach that high. It'd be worth over $50 million. Not 50,000, not 5 million. $50 million over time. True. Go check it out yourself. The whole point is that when it looks the bleakest is sometimes the greatest opportunity. And so this year is going to be a year of opportunity for those who choose to seize it. You're going to have inflation. You're going to have interest rates going bonkers. Like God knows what they're going to do. They're going to have to increase it because inflation rates are just off the charts. We have not seen that in a generation, period. We're going to see what's going to happen. And you're going to see a reckoning for these crazy valuations. Because as Grandpa Buffett said, interest rates are gravity, and we've been living in a world with no gravity. So you had a whole bunch of companies climbing up the mountain that shouldn't have been. They weren't prepared. And we were just throwing money at them, and they were like, I'm the greatest thing ever. I'm a mountain climber. Here's your pack. Tumble, 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 right down them. Right. They're going to fall right off that mountain. So it's a great opportunity for those who want to seize it. That's my personal opinion, and I think that history backs me up. But regardless, if you're buying good companies that pay you to own them, we're not so worried about the company's value. We're worried about the revenue that's being received. When there's pullbacks, that's our greatest opportunity to go shopping for sales for companies you've always wanted, right? It's kind of like this. Like, I've always wanted those shoes for my wife. I've always wanted that purse. And if it went on sale, I'm getting it. If you have those companies that are on your list that you said, you know what, that's a great company. I've always admired that company. I use that company all the time. I want to own that company. Now's your time. And just look at what you do on a daily basis. Look at what you use consistently. If you're a Verizon fan, buy Verizon. If you stop at Chevron on your way home, buy Chevron. If you love Costco, buy Costco. Just start buying the companies that no matter what's going to happen, they're still going to be there. Like, 10 years from now, that's still going to be around. And get rid of all those companies that aren't in that equation. Don't buy the things that are the flash in the pan or that somebody on TV told you to buy. Buy things that are great, good, great companies. We're not going to say good. Great companies, good value at the time. Load up, buy them over a long period of time, and quit worrying about it. You're going to be really, really well off if you do that over the long haul. And then hopefully, this is history repeating itself. We'll be looking back in 20 years going, man, everything was on sale that year. I'm glad I stocked up. And not to belabor the point, I'm going to have to do a video just on Buffett's quotes. But he says, when it's raining gold, don't bring a thimble, bring a bucket. And I think this year, you're probably going to be looking at that scenario. Hey, guys, if you like these videos, please subscribe and like it. It really makes a huge difference to us on the little algorithm. And also, if you know anybody who would benefit from this, if you know anybody that's having trouble starting to accumulate wealth, or they just can't get their head straight, or they are falling for a lot of all the shenanigans that are on TV and this advisor and that advisor, share the video with them. We'd love to have them be part of our community, and we're glad you're part of our community.